Welcome back to another episode of SaaS Buyers Club. I'm your host, Omeed, and I'm the managing partner at Optimist Legal. We're a full-service corporate boutique law firm that helps SaaS founders from incorporation to exit. Anything that has to do with contracts is what we help SaaS founders with. So incorporations, entity formations, terms of service, master services agreements, venture capital raises, and exits. Those are really our areas of focus. In addition, if you're watching this, you are watching SaaS Buyers Club, which I'm the host of. And the mission of SaaS Buyers Club is to help SaaS founders get the best exit possible. Because here's what I believe. I believe anyone that comes on this show and can share value that would help SaaS founders increase the value of their business will help them get a better exit. With that being said, I'm pleased to introduce Okan. Okan is head of SaaS at ComCap. Okan, tell me a little bit about ComCap. Tell me a little bit about you.
Yeah, thanks. Thanks, Omeed. Thanks for having me on the show. Good to see everyone. ComCap was founded back in 2012 out of San Francisco. We are a boutique advisory firm that 100% focuses on technology verticals. I spearhead our SaaS vertical. We do have other bankers that have specialization in other verticals, in tech and tech-enabled verticals. And we provide strategic advice on M&A, mergers and acquisitions, both representing the sellers as well as representing the buyers, as well as, fundraising and corporate divestitures. We have about 40 people globally, and we differentiate by having a kind of single P&L. So once you're a client of us, you get the entire support of our organization behind you. And your process would be led by, individuals with 10 plus years of experience like myself with thought leadership and day-to-day execution.
Awesome. Thanks for that rundown of ComCap. You're head of SaaS at ComCap and you help SaaS founders exit. What would you say is the number one thing that you want SaaS founders to get from the episode today?
Yeah, I think, there is a number of things, but if I would summarize it under, maybe one bullet would be you have a number of options. So being aware of kind of different types of buyers and investors out there and different types of deals, different structures is important. I used to believe kind of back in my days, I'm originally from Turkey and I was kind of always interested in tech, reading about kind of Silicon Valley startups coming up that really amazed me. And I wanted to be a part of that change, which is why I kind of moved to the Bay Area 16 years ago to have my MBA. I used to believe the only path to success was by kind of raising traditional capital by, seed rounds, followed by a Series A, B, C rounds, and then, pursue an IPO. And my 10 plus years of career showed me that that's not the only way to success. And that's actually, very rare. I could also SaaS founders who do that and reach that status. But I've also seen a lot of founders who either choose a bootstrap journey, did kind of like debt raises along the way, ARR-based financing and others to reach an exit and made millions of dollars in their pockets, all the way to private equity firms coming in, helping them with a platform acquisition strategy and help them grow organically and inorganically. So I think, taking a step back, you as a SaaS founder have a number of paths and, they all can lead up to success. It's just, I would recommend to sit down, take a step back, work with an advisor like ourselves to think through your options, what makes the most sense for your specific business and vertical. Because, even within SaaS, there is nuances and differences between horizontal solutions versus vertically focused solutions. Within horizontal, whether you're dealing with more enterprise clients or SMB and mid-market clients. So there's a lot of detail that comes into play. So, having someone that's specialized in SaaS, but also then the sub-vertical adds a lot of value.
Cool. It sounds like what you want SaaS founders to get from the episode today is an understanding of various exit options. Yeah, the various strategies to exit, whether it's, a strategic buyer or the different types of buyers. For example, it could be strategic, it could be private equity. And then it also sounds like one of the things that you have grown with respect to is you thought that there was a more linear approach to success in startups. It sounds like that linear approach that you believed before was, you follow the traditional kind of VC route until you either IPO or you exit for like $100 million to Apple or Google or Facebook or something like that. But you've come to realize actually that there are many different variables that could lead to success. It doesn't necessarily have to be that you raise venture capital and go through the various funding rounds, essentially those two very limited options. It could be you raise one round and then you exit. It could be that you bootstrap and never raise a round. It could be that you raise multiple rounds and then, maybe you sell to a very specific type of buyer, like, for example, private equity. There are actually a lot of different pathways that a founder could take to success.
Yeah, exactly. That's right. And, one key analysis that an investment bank typically does is kind of what we call a waterfall analysis, the proceeds analysis. In an M&A scenario, the money coming in from the buyer, how that gets distributed to various stakeholders among the company, including the debt holders and the equity holders. And, after running, I don't know the number, but like probably hundreds of proceeds analysis like that in my career, yes, to your point, I've seen occasions where the company was very lightly capitalized or bootstrapped, and the founders ended up making, significant portion of that money coming in, and they were extremely happy with the transaction. And on the flip side, I've seen situations whereby, very diluted founders, and kind of not ending up getting the outcome maybe they would originally would like to pursue. So, being aware of all those options early on in your journey can add up a lot when you're kind of weighing in on your options in the early days of like, do I raise a Series A round, or do I use maybe a little bit more ARR financing or debt, or how much equity I'm willing to give at this round and how I'm going to use those proceeds. Because I would say the buyers and investors today a lot more are sophisticated than the buyers and investors of like, say, 10 years ago. In my experience, I've seen the trend of like, we were able to pitch a business and just a product, and based on the product to the potential acquirer, they were throwing up IOIs in front of us. I would say that's no longer the world that we live in. In today's world, most buyers, almost all, would love to see kind of SaaS KPI package in the data room. They would love to review that and better understand, not just kind of at the company level, but also looking at your ICP. They expect you as founder to have a very strong understanding of your core ICP and have that kind of retention and on a net and gross basis, and all the, surrounding KPIs are trending, as well as they expect better understanding of your kind of churn rationales for each significant client that churned in the last, say, 12 to 18 months to see they going to your competitor, etc. So yeah, 100% being aware of the ecosystem and what people are expecting you to be knowledgeable of at the point of an exit is very important.
Interesting. So you're saying buyers have become more sophisticated, which requires founder, and the way that they've become more sophisticated is specifically they expect the founder to have a much stronger grasp and understanding of their own business.
Yes, that's right.
Talk to me a little bit about the founders that you work with. The market has matured and become more sophisticated, is requiring a greater level of sophistication from, the acquisition targets. What is it that you typically see when you work with clients?
Great question. So we look for kind of businesses that are on the, I would say, low end, 5, but ideally closer to 10 million of ARR. So, 10 million of ARR it brings in scale premium, and it opens up the door to a number of potential parties that goes beyond just strategic partners. Again, we've talked about private equity buyers. Typically, most of them would have like a 10 million ARR as their kind of lowest threshold. to look at an asset from a platform acquisition point of view to then help buy other assets under it to kind of build. We look for kind of growth businesses that have, rule of 40 dynamics, either the business is growing healthily and, maybe burning cash at the expense of burning cash, or maybe, it's profitable growth or path to profits, visibility. Because again, those are some questions that, potential partners do ask us in the first interactions is kind of what is the business's trend on a rule of 40 scale, and kind of do we have clear visibility into profits in the next, say, 12 to 24 months, especially if it's private equity discussion. On strategic, it's a lot more kind of retention dynamics comes into play. Enterprise versus mid-market focused SaaS businesses have different underlying benchmarks, but typically kind of top to second quartile of retention metrics are appealing to those buyers. And I've seen kind of buyers walk away from situations where kind of the retention metrics are kind of lower, significantly lower than the industry benchmarks. So that's in a nutshell what we look for from our clients.
Got it. And these are clients that you will take. So these are the metrics that you look for in terms of people that are a fit for you.
Yes.
Let's say, someone comes to you, they're at 10 million ARR, for example, and, they've achieved the rule of 40 metric. How are you typically working with these clients?
Yes, great question. And they typically reach out to me or us kind of either when they're at that point in time where they want to transact, or maybe 12 to 18 months in advance. I actually recommend founders to start relationships with a handful of bankers, not just ourselves, but having optionality is important or finding the right fit. But I recommend people to start building on that relationship 12 to 18 months in advance. The way we work with them is kind of series of sessions to get me, and obviously there's a big team supporting me up to speed on the business, including us and kind of legal advisors like yourself. At occasions, we would bring in kind of third-party accounting firms to do QOE. So all the advisors that's going to be surrounding the transaction does need sufficient enough time to kind of get their hands around the business and better understand the story. Because M&A is about storytelling. There needs to be, a clear, concise, and effective story of where the business is today and where it's heading and how it can fit into this kind of potential partner and how 1 + 1 can be greater than 2. If we deliver that pitch very effectively, that's how we drive premium multiples in our transactions consistently.
Talk to me about multiples. Every founder always wants to know about multiples. What do you tell founders when they ask you about multiples?
I mean, that's probably the number one question that I get asked on a weekly or daily basis at this point. And multiples have fluctuated a lot. When we look at it from a kind of last 5 years perspective, we do actually have a ComCap SaaS index, which consists of like some 100 public companies. And when we put them on a chart, what we see is kind of the current state of the market is above the last 5-year averages, although it can be, it is lower than where those multiples were, back in 2021. The overall sentiment is kind of multiples are not going to get to those levels at least in the near to midterm. So if you're considering an exit, signals are this is a good time to run a process. Q4 of last year actually was one of the highest levels of activity in SaaS. Q1 numbers are probably coming up shortly, and I would expect to see healthy amount of activity in Q1 based on my buyer and private equity discussions. Both parties are eager to deploy capital to, good businesses. They're actively searching. There's a lot of detail that goes into, so it would be very generic for me to say, hey, expect like a, high single digit ARR multiple on your exit. Again, there are a number of factors going in, like your revenue, historical revenue growth, your EBITDA margin, your gross margins, your and gross retention rate, your customer base, whether it's enterprise or SMB, your customer concentration, whether it's geographical concentration, sectoral concentration. Obviously, the more diverse your customer base is, the more premium it transacts to. And, within your specific vertical, inorganic growth avenues. Are there a lot of competitors out there that might be facing some headwinds, and can we do like a consolidation play and pitch that to a private equity firm? That could be quite appealing, and you can be the platform. So there's a lot goes in there. What I can say is top quartile businesses that lands really well in almost all these aspects. Like I was on a call with a potential client yesterday. It's a SaaS business growing about 300% year over year, while being 20% EBITDA margins, diverse clients, enterprise. They're going to hit 10 million, in the next couple quarters. That business is going to have a significant premium multiple as compared to most of the deals that you might be seeing out there in the market.
Yeah, talk to me about most of the deals that you're seeing in the market. And I think a lot of SaaS founders think that, this multiple aspect is something that they more control over in a deal. And what I mean by that is it seems like they think that there's like a lot of negotiation that, for example, happens around this multiple piece. I'm curious, what's your experience with that? So the two questions are, the first one is, you said most businesses obviously are not hitting 300% and 10 million ARR in the next, few quarters and having like great customer concentration. They probably have more reasonable growth and so on and so forth. So what are you seeing, with respect to that? And then also, what is like the negotiation around multiples really look and sound like in a deal, just to paint a clearer picture for SaaS founders out there?
Yes, no, for sure. We do work with kind of companies that have kind of relatively low growth and path to profitability as well. I think when it comes to that, like better understanding the core ICP retention metrics becomes key, and the strategic fit, because we like to create a synergy model up front so that we can articulate it to the corporate development individuals and the CFOs of potential parties to illustrate the revenue synergies and how much potential upside they would have from acquiring our client. And for those businesses, I would say the multiples range from mid-single digit, 4 or 5x to kind of high single digit ARR multiples. To address your second question, kind of how much room there is to negotiate, I advise my clients not just to be stuck on the revenue multiple per se. There are a lot of other details surrounding a transaction that can bring up a lot of value, like kind of earnout elements, whether the earnout is going to be contingent upon what, that's a topic of itself. Deferred consideration, whether it's kind of maybe employment based. So as long as you're employed with the business and help make smooth transition, you continue making proceeds. Equity versus cash. Obviously there's a mutual understanding that a founder at an exit would look for some liquidity, but occasionally buyers like to incentivize them by kind of equity that they have, and kind of we do a lot of kind of diligence on the buyer. So it's not just buyer doing diligence on our clients. We do diligence on the buyer and their stock, so that we can weigh that into the context of kind of how much value are we getting today and what that value would look like in the future. There is definitely some room to negotiate, but the more options that you have and the more effective of a process that you run brings you that kind of negotiation power. So if you were ever in an exclusive one-to-one discussion with a potential buyer, you're not at the power of kind of having the greatest outcome, in my experience. So, we have had clients where they reach out to us at a point where somebody knocks on their door, sniffing around the business. They had a couple of meetings. They expressed verbally, like, they will be submitting an offer relatively soon. So they come to us and ask for our advice on how to handle that inbound, as well as quickly go out to a handful of their competitors or other potential buyers out there to maximize value.
Makes sense. Okay. So it sounds like the answer to the negotiation of the multiples piece is, hey, there's actually a bunch of tools that you can utilize. It's not necessarily specifically, don't focus so much on the multiple negotiation, but it's more like, okay, if there's a number that you want to hit in terms of exit value, there are a few various tools that you can utilize. And the three various tools that I've, for example, heard you reference is the earnout, employment compensation, or, equity rollover, essentially.
Yes. Those are kind of some high level, there's obviously a number of other things that go in and kind of the list is quite long actually. And so I advise my clients look at it in the context of everything else, not just the multiple.
Right. Do you know who Adam Robinson is?
Well, no,
okay, cool. He's like right now on LinkedIn, he's like an influencer on LinkedIn. He's a SaaS founder. He runs a SaaS company called retention.com, which is essentially like a retention tool for SaaS businesses. And he posted a post the other day that was talking about how he had an exit in the past. Essentially, he was saying, don't use an investment banker or a broker in a deal. That was essentially the point of the post. I've heard like some SaaS founders say this as well. They're like, well, what do I really need, a broker or a banker for in an exit? What would you say to something or someone like that?
I mean, my sincere feeling here is you would almost always leave money on the table by not having an advisor on your side. I've seen in my career on my transactions as well as my other colleagues' transactions, the offers increase significantly from the initial offers the company got inbounded by to the kind of the final transaction value that myself, us, or other bankers that I know of delivered to their respective clients. So you need to understand here that the buyers almost always have corporate development individuals on their side with tens of years of experience in investment banking. Not just one, most of the large public companies have a corp dev team of kind of a handful of, if not 10 plus individuals working on their side to kind of obviously get a good deal out there. We would just kind of level up the fields by kind of being on your side, because most entrepreneurs, most successful entrepreneurs that I've seen, have had maybe 2-3 exits in their life cycles. Our job is to negotiate these deals on a daily basis. We have a lot of data points, a lot of tips and tactics. And it's just kind of also the mutual understanding of, having an advisor on a client side, on a founder side, signals we are also talking with others. There are other parties interested in the business and they cannot get a good deal out, put their lowest bid out there and expect that deal will, transact. We have our own databases of transactions and multiples. And so, I honestly disagree, and I would look for him to, explain and articulate like, where is that argument coming from? What you can see on for example, LinkedIn is, if you scroll down, you'll see a number of founders and CFOs that I've worked with in the past, kind of putting publicly available testimonials of kind of the added value they've seen on having us on their process.
Yeah. And what would people find in terms of the added value? Like, what do you think the actual added value that you have brought to the deal outside of, the point that you shared in terms of an investment banker or broker through running a process and bringing the experience and knowledge of essentially the equivalent of a corporate development team of a potential buyer? Obviously, that's recognized, but just curious, what will founders find in terms of the added value outside of that?
Yeah, just having so there are different phases, and we add value, I would say, from the entire process from start to finish. But like starting off with like the preparation phase, there's the equity story build up, and yes, the founder is intimately close with the business and he might have a perception of the business today, but having us as a third party coming in, making an assessment, comparing it to other companies that have been worked with in the past and have data on gross margins and all the other kind of financial line items, as well as or kind of continuous intelligence from speaking with buyers out there and what people are looking for today and will be looking for in the next 6 to 12 months. We can tweak some of the kind of strategies going forwards to maximize the value in 6, 12, 24 months from now. So I have clients right now who are asking us to work on their budget for the rest of 2025 and 2026. So we're helping them think through sales and marketing spend, kind of team build-ups, etc., to prime them for an exit or access to the potential buyer universe. Again, even if you might have an offer from your top potential buyer today, we can quickly hit, a handful, if not, a long list of buyers really quickly, speak with them and get them up to speed so that you're not kind of exclusively negotiating with one party. You would be surprised how fast there can be a turnaround and other parties might be in the mix. That again increases your power. A founder's primary objective is running the business healthily and staying, focused and delivering revenues and this whole process takes so much time that we take that distraction away from them as well so that the business doesn't get impacted. I hear on the flip side stories of founders getting inbounded and they spend significant amount of hours and legwork to prepare the diligence answers and spend time with that buyer to then only realize there's a huge gap between where the perceived value is and where they're willing to trade. So like we take all of that away from a buyer and we have from a client and we handle all those discussions on behalf of them in a kind of mutually collaborative way. Those are just some high level, again, this is a full-time job for us. It's, and it's kind of involves weekends, holidays. So there's a lot of work that goes in from a good advisor point of view. Again, I don't know his personal experience from his deal. Again, the people that I've worked with in my career have good things to say that's publicly available.
Yeah, I'll have to send you the post. I'm curious what your thoughts are on it. It was an interesting post to read. I read it and I was like, I disagreed personally. And essentially the point of the post was like, oh, anything a broker can do, essentially the lawyer can do as well. And if I were to go through a process again, I wouldn't use a broker because, the lawyer is responsible for actually like consummating the deal. And I'm a lawyer and I read it and I was like, I disagree.
Sure, lawyers have a ton of value. I have huge respect to lawyers like yourself. And I've worked with some great lawyers in my career. And having a good legal counsel is key to also getting a good M&A transaction, in my opinion. In my experience, it's a complementary effort, lawyers, investment bankers, and as I said, third-party accounting firms to the extent the company doesn't have a strong CFO or I'm sometimes talking with companies, even 10 million ARR following cash accounting, not kind of accrual accounting. And, we need to convert those numbers obviously to accrual to make it more apples to apples with potential buyers. So the advisory team surrounding a transaction works really complementarily together and add value to different aspects. So that's all I can say about that.
No, I agree with you. I think that each role needs to be filled, and where each role is fully operating in the way that they should be operating adds a lot of value to the deal. The broker has a function, and I would say that one of the most important functions of the broker is access to a process around preparing the company, having access to, the pool of buyers, being able to tell that story. And actually the broker is a great intermediary as well. Where the broker is an intermediary, the lawyer can often, be essentially the tougher part of the team in terms of, really defending and fighting for the things that the client's looking for. And then as well, like obviously the lawyer is responsible for the closing of the deal as well. The closing of the deal isn't going to happen without the lawyer. So I think that, it's like.
Definitely. The merger agreements are, at a minimum 100-page long document, a lot of legal language. My personal experience on those situations is, investment bankers focus on the commercial terms of the merger agreement, kind of the things that are related to the purchase price, the calculation of the earnout, net working capital calculation, kind of the employment retention packages, etc. So anything that's kind of tied to dollar amounts. And if typically the investment bankers would review in great detail and weigh in with their commentary and help negotiate. And then, the lawyers would review everything else, which is like 75%, maybe 80% of the actual document itself. They can add a lot of good protections surrounding the founders and kind of make that process a lot more streamlined, especially good lawyers like, yourself, who's more solution oriented, versus, I've been also in rooms where the discussion takes really long on a very, minor point. So like having constructive, smart individuals surrounding the business is key, to also not get stuck on kind of, again, you need to weigh in. You're not going to win all the battles. You'll look at it more from a holistic approach. That's my advice to my clients, because there are so many details that surrounds an M&A transaction that if you get stuck on one point, we need to be aware of that. So maybe let's fight to win that, but we might then be trading off chips on somewhere else, because the buyer also needs to feel like they're having a good deal and they're getting a kind of good transaction and the right protection surrounding them in terms of the future.
Yeah, it's such a human process. I think that's something that people don't realize, is how much of a human and relationship process it is. And people are often surprised when, like the humanness of the transaction is really felt in terms of like personalities and so on and so forth. Or just like oftentimes in the compromise process, understanding how the other side might, feel or receive, or, how they might be impacted by, certain actions that are taken, or even certain words that are used, or certain things that are said, all these things, a good level of importance. You said something though that I think is really important to address here. How long do the majority of transactions in your experience take from, taking the business to market, or a client essentially coming to you and you've identified that they are a client that's a fit to work with, and you help them prepare? I know you said 12 to 18 months, in terms of that's the best time for them to talk to you about starting a process. And then, during that 12 to 18 months, you're probably helping them prepare, as you mentioned, for example, taking them from, a cash basis to an accrual basis. That's probably part of the process, running these sort of like waterfall analyses and so on and so forth. But that's everything pretty much prior to taking to market, I would imagine, in that 12 to 18 month period. Or is it, how long does it take for them to actually sell the business?
So long story short, I've had clients where from us signing the ink of engagement letter with us to money in their bank account was about 40 days. But that was kind of, they already had a inbounded party on the table. They wanted to make sure kind of they have somebody representing them on that negotiation table with experience, steady hands on the deck to make sure we maximize the outcome, and B, kind of help push a smooth closing phase. You got to realize, and I think, you as lawyers have a lot of experience with this, but after an LOI is signed comes the confirmatory due diligence phase. And it involves not just legal diligence, but HR, tax, finance, accounting diligence, and other topics, IP diligence, tech diligence. And that process is kind of quite kind of time consuming, yet alone very, unorganized occasionally. So us as bankers, and my team is great at kind of coming in and kind of putting more organization into that kind of process to make that as smooth as possible. I wouldn't want anyone listening to this to set the expectation of 40 days, but I thought that was the fastest in my career. Typically, on average, from start to finish, if there is no inbound and it's just proactively, we're going to start thinking about the potential parties and reaching out to them. It used to be more of 6 to 9 months, but nowadays, because of the buyers being more sophisticated and they want to do their diligence a lot more deeper, I would say that timeline is more like 9 to 12 months is where I can comfortably say we can look to get a premium deal for our clients. Going back to one comment you made, which I, 100% agree about the human element and the emotional journey. An M&A process is like a roller coaster ride. There is ups and there is downs, and I almost feel like we act as occasionally psychologists to our clients, delivering those tough to hear news in a way that we can survive from it and have a still premium outcome, and also the good news, and end up spending so much time with our clients, significantly more than our significant others, and build that bond. So, which is why I think when you're picking up an M&A advisor or a lawyer, I would say it's healthy to have a couple options and see who fits your style and your personality better, and who's going to be there when you have an urgent question on a Saturday or a holiday, and who would you like to spend that intense 20-hour, 30-hour a week period for a significant amount of time of like 6 months to 12 months. So those all come into play.
Awesome. Love it. So I want to ask you, what's a tool or a tip that you can give to SaaS founders right now on the show that would help them in their exit process? Like something that maybe you like to see from SaaS founders outside of understand your metrics, understand your KPIs, that sort of thing. What's something that SaaS founders can do right now today? Let's say they hit, the 5 to 10 million ARR mark. Know that you want to see this thing from SaaS founders before they come to see you, because it would help them with their exit process.
I would say just having a data room. The one aspect that slows us down is and you would be surprised how even companies that much beyond 10 million ARR not having, a well-prepared data room. So I think it's always healthy, when you start crossing the 5 million ARR mark, to start building a data room. They can, feel free to reach out to me, and I would be more than happy to share what a a level 1 data room would look like in terms of pre-offer stage, and what would a confirmatory data room would look like when somebody is looking to acquire it after an LOI. So I think having that data room prepared to the extent they have a legal counsel, having all those contracts organized, making sure they have the signed copies from both parties, because I've been involved in situations whereby a lot of the documents were missing, and obviously the buyer wants to make sure that they see that before they acquire the business, and like that slowed us down significantly. So being well prepared from a data room point of view is important. And for all your listeners, I would be more than happy to the ones that are getting closer to that 10 million ARR range or beyond, happy to give them a free valuation estimate if they reach out, and we can get some data from them in terms of under NDA, their profile financially, etc., and come back to them with our thoughts on what's the current state of their valuation.
Awesome. Love that. Yeah. Interesting. And what's like a harsh truth that people in your industry maybe don't talk about, or what critical thing do people skip over when they try to reach their result?
I think that goes back to the Adam's comment about sometimes what value would an investment banker bring in, and whether they can handle, especially when they have an inbound party on the table, whether it makes sense to handle it themselves versus bringing us on the table. What I would say is, you're having a lot of discussions with that potential buyer pre-acquisition. Some involve good comments, but some does definitely involve hard to difficult to hear comments. And there are comments that you want to give to the buyer as well that might be perceived negatively by them. So again, having an intermediary like us in the middle, listening to all your thoughts and then delivering it to the buyer in a way that they can digest it. And as well, occasionally we can be the bad cop for you so that you can continue being positive about the synergies and the future with them and excited. I think maximizes the outcome because you don't want to damage the relationship from both parties. We very much occasionally become the bad cops in those discussions where our client always continues to be a good cop.
Can you give me an example?
Yes. So let me think about which one would be appropriate because I've heard many comments in my career, obviously. But say that it's a very technical founder. I've had this one situation where very technical founder, proud of what he's built, the technology stack, and kind of all the tech surrounding the business. And the buyer does believe the tech is outdated and the tech is kind of, they want to acquire the business and they do see great fit, but they do believe there's going to be a ton of investment post-acquisition to the technology to take it up to the same level as the buyer's tech stack. So obviously that would have been a very tough thing to hear if it was directly from the buyer's mouth to the sellers in a one-to-one discussion scenario. But, we were in the middle. We heard that feedback. There's different ways to tell the same thing to someone, without changing the facts. So like we delivered that. We took his feedback, which was kind of disappointed, but at the same time, understand to a certain degree. And we worked with them to get a deal done. So like, this is just one example. There can be many. There is always many other things that happens positively and negatively. Sometimes, our clients' initial reaction to an offer is, no way, this is insulting. We want to walk away from this discussion tomorrow, and ends up kind of maybe that party being the ultimate buyer. And, yes, with certain negotiations and tweaks. So you don't want that kind of initial reaction to be just in front of them at the moment. So we do a lot of side discussions with our clients, give them context, give them data to support maybe the buyer's argument, etc.
This is the psychologist piece, probably, that you're like psychologist, PR, communications expert, best friend, confidant, all of those things.
Exactly. That's we become really good friends after transaction. So what we do is, and very often lawyers would be also invited to those dinners. We do closing dinners and we share kind of stories from the process, and we celebrate together, and and this is a lifelong friendship afterwards. I totally agree.
Yeah. I mean, if they're at 10 million ARR, exiting at a 4 to 5 to potentially as much as 9x multiple, that's, a life-changing exit event. So
sure. I'm always curious to ask at that dinner table, what was the impulse buy that they make, exit? And kind of one interesting thing that I heard, it was, I think, 4 founders, 2 of which bought the same dinner table, which was kind of, I found very, very funny. Without knowing each other, buying the same dinner table. That was kind of a high-end wood dinner table. They ended up buying the same thing, and bought it at the closing dinner, which is funny.
Yeah, how many of your clients bought a yacht? I'm just curious.
Well, one bought a ticket to the space. I think it was like $1 million ticket or something.
Oh, interesting.
He sold that business for about 100 million. 2 brothers. So yeah, that was
no yachts yet, though. It sounds like.
I haven't heard of a yacht. I heard houses, and again, the most interesting one was the dinner table.
Dinner table, huh? Interesting. Yeah, I love that question. I think I'm going to start asking that on the show. Like, what's the most interesting thing what's your impulse buy? I think that's going to be the question. I love that, actually.
Me as an advisor, mine is a good cigar and a good glass of whiskey. That's celebrate a nice transaction.
Do you guys do deal toys? Have you heard of these deal toys?
Yes. We do deal toys. We share it, with our clients and advisors surrounding the transaction as well, to kind of memorize the good deal more physically in the future.
Yeah, like a little trophy case, essentially.
Yes.
What are some other mistakes that you see founders making that you think is important to call out, specifically and especially, mid-deal?
goes back to kind of need to be stayed focused on revenues and delivering kind of on the budget. What I've tried to avoid from my client's perspective, and obviously it's outside of our control, is the business momentum. In an ideal scenario, you would be hitting, if not beating, the budget that you projected at least for the next 12 months. In my approach, I don't really focus on the next 3 to 5 years. I think it's really hard to predict. It almost became more of an academic exercise to forecast 3 to 5 years. But the next 12 months is key in an M&A process. And, I recommend all my clients to just be ready to just purely focus on the business for those 12 months and beat your budget that we mutually communicate to potential parties. And ideally avoid any negative press and any kind of surprises along the journey. By surprise, what I mean by is I had a mobile gaming client, and kind of despite our advice, they decided to launch a new mobile game in the midst of a process. And obviously, whenever there's a new product coming into the market in the midst of a process, all the buyers are interested in its performance. It's like, and in mobile gaming, it's more closer to like, entertainment. Like a movie can be a blockbuster movie, or, it cannot have the same results that you anticipate. So it just, long story short, the new app didn't perform as well as the previous apps. So it kind of took away from the credit of the previous success story of the previous games. And such, we ended up kind of pausing the process and like relaunching it in about kind of 12 months once that kind of time has passed. So any key product launches, etc., ideally would be either before the process or kind of are planned for after the exit.
That's a great piece of advice right there. Just as a last question to conclude the show, really appreciate you coming on. You've shared a lot of really valuable information, and I'm looking forward to having, people be able to connect with you as a result of the show. One of the things that you mentioned is one of the benefits of working with you as, a banker and an advisor is you see what's coming in the market, in the next 6 to 12 months, essentially, in terms of what buyers are looking for. I'd love you to just speak, to that a little bit. And what are you seeing in terms of market trends for the next 6 to 12 months?
Yeah, definitely. That's one aspect that a lot of founders, I think, actually are not paying as much attention to. So like, one common perception that I'm seeing is everybody's focused mostly on what's good timing for me and like when I want to transact. But what you need to realize is it's equally important what's a good time for the buyer, because your most likely acquirer, let's say, are a handful of them out there. What if they are in the midst of acquiring another business and their hands are tied in the time that you want to hit the market, or they just acquired one of your competitors? So like, there is a lot of, and I hear this all the time, where we launch a process and reach out to potential parties, and one of the most common decline rationale is not actually this product or this company is not a great fit to us. It's mostly, hey, we do agree this company fits well to us, but we're just timing wise is not a good time for us. Are they open to kind of opening up the dialogue again in about 6 months or 9 months? So that is why I suggested earlier to reach out to us or advisors kind of maybe 6 to 12 months in advance of the ultimate exit time frame that you want to kind of get there, so that we have enough time to pre-market, what I would describe pre-market the business without really communicating the business is on sale, but like introducing you to the potential acquirers. Because, large organizations, it's really difficult to get all of the key decision makers into a room to meet you for 60 minutes. So very occasionally we break that discussion into a series of meetings, one meeting with their CFO and corp dev team, another meeting with their kind of CTO and the product team, another meeting with their CEO. So like those meetings, getting those calendar, takes time and effort. So like the sooner, the earlier someone kind of engages with us and start those efforts, the highest likelihood of success we can expect to have.
Great piece of advice. Love that. And I think that's where we're going to conclude the show. So Okan, everyone, Okan Inaltay at ComCap, broker, advisor, banker, works with SaaS businesses. Really pleased to have you on the show. Okan, thanks so much for joining. You've shared a lot of really valuable information.
Thanks, Omeed, for having me. And yeah, great talking with you.
Absolutely. And for everyone out there, this has been another episode of the SaaS Buyers Club. Thanks so much for watching. Okan's contact information will be in the show notes below. I'll be linking his LinkedIn. I'll link ComCap's website, and you'll be able to reach out to him that way. As always, thanks so much for joining. Make sure you like, subscribe, comment. Let us know what you got from the episode. Let me know if there's anyone that you would like to see on the show. And we'll see you next week.